Hello, welcome once again to our YouTube channel. For today's very lecture, we'll be looking at capital budgeting. And to get started, let me say we have what we are looking at as capital budgeting. Okay, so we are looking at capital budgeting. Right, and we'll be using our spreadsheet to be able to look into that. Now, what is capital budgeting? First of all, capital budgeting is just a method of estimating the financial viability of a capital investment over the life of the investment. And for those of us who are not in this accounting line or finance line, unlike some other types of investment analysis, capital budgeting focuses on cash flows rather than profits. So we will be looking at a particular problem here. Okay, we'll be looking at this very problem, and we'll be looking at how we can be able to come up with several capital budgeting analysis methods. And this is because there are several capital budgeting analysis methods that can be used to determine, like I said, the viability or the economic feasibility of a capital investment. So capital budgeting involves identifying the cash inflow and also the cash outflow, rather than just accounting revenues and expenses that flows from a particular investment. So right here, we have a problem, and we have to solve this using Excel. And for the methods, we'll be looking at our NPV, okay? We're going to look for, and say, required. Okay, so we are required, okay, to calculate our NPV. We're also required to, calculate, say, one NPV. And I'm sure you know what the NPV is, because the NPV is just an acronym that stands for net present value. And when we are looking at the NPV, what we are just talking about is that amount by which the present value of the cash inflow exceeds the present value of the cash outflow. And if you remember, when I was explaining that of the capital budgeting, I said that the capital budgeting is very important because it involves identifying the cash inflow and cash outflow rather than just the accounting revenues and expenses. And I said it focuses on cash flows rather than the profits that is being made. And the net present value comes into play there because it is the amount by which the present value of the cash inflow exceeds the present value of the cash outflow. And we know that the cash flow, is very an important statement. Okay, so if the present value, for instance, of the cash outflow exceeds the present value of the cash inflow, then we can say that the net present value is negative. Otherwise, the reverse. So that's just for this NPV. So we're also going to calculate that of our the internal rate of return, which also has an acronym as IRR. The internal rate of return is also another method too, in which you can, say you want to, or another approach of analyzing, the year-end capital budgeting. And it's basically just the rate of return from the capital investment. For example, we have an initial investment here of 100,000 naira. So that rate of return from this investment, is the internal rate of return. And then I can put it that internal rate of return is the discount rate that makes the net present value to be equal to 0. So please just take note of what I just said, because in this solving, we're going to see how that is possible. Like I said, that internal rate of return, simply put, is that rate, okay, that makes the net present value to be equal to what? 0. And it's very important here for us to take note of it, because when we are trying to, by the time we are working on the net present value analysis, the internal rate of return can be compared, okay? So as for us to see if we can come up with a conclusion that yes, this investment should move forward or this investment should not move forward. So also we'll be calculating that of the PI, okay? And then the PI is what we call the Profitability Index, and it's very important. Okay, so a very important method here too. So we have the net present value for NPV. We have the that of the internal rate of return and the PI, which is the profitability index. So for those of us, in order for us not to be confused, I can say this is our net present value. Okay, and I can say this for our internal rates of return. Okay, and this is our this for profitability index. Okay, so say bracket open PI. Please, this is not pi. This is not coin. Okay, this is not coin. I know when we talk about PI, the person should be thinking is pi. It's not a crypto, whatever. All right, so say this for our I arrow, and this for our net present value. That's our NPV. Okay, this for NPV. Okay, good. So this is basically what we'll be looking at for. So the profitability index is also very important here because it's an important variation of the net present value approach. When it comes to comparing projects, those of you who were there in my SAGE class when we looked at how to track cost by project, the profitability index is very important because though the profitability index does not stipulate the amount of cash return from a capital investment, but one of the things it does is that it provides the cash return per the naira that was invested into that very project. So the profitability index is very, very important, most especially when you are working here. It's very important. So moving forward, we are going to look at this question, and we are told to assume that we have year. Our year is from year 1, 2, 3, 4, 5, and this is more like our discounted. Okay, I know we are not going to discount this. Okay, so we're not going to discount the cash flow for today. Okay, because it is 0. So we'll just proceed. We'll just proceed right here. All right. So we have our cash flow. Okay, we have here negative 100,000, and from year 1 to year 6, we are having 50,000, 60,000. 50,000, 50,000, 6,000. So then our cost of capital is given as 5%. Okay, it's given as 5%, and it's very important that we are able to look into this. Okay, because having an understanding of what you are about to want to analyze is very important. Okay, so the cost of capital is given as 5%, and it is just basically the rates to be applied to our expected future cash flow. Okay, and it's very important that we put that into consideration because we cannot say we want to calculate this without our cost of capital, which could refer also to our discount rate. So we must make sure that all we have the necessary understanding of this. And like I said, the cost of the capital of a firm can be analyzed. Okay, it can be analyzed. Majorly when we are looking at we're trying to ascertain whatever we want to do here. Okay, and it's important we are able to justify this, okay, for our capital budgeting project to be successful. All right, so moving forward, so I'm going to come over here. Okay, we have capital budgeting, so I'm going to say this is our solution. So let's say this is our solution to that problem. Okay, solution to that problem. Okay, all right, so we will also say this, the name of this company. Let's the name of this company, it's Miramore Consulting. Solving this for me, right? Attempting this for Miramore Consulting. So this is Miramore Consulting. Okay, all right. So moving forward with this, the first thing we are going to do is that we are going to bring down. Let's bring down from the equation here where we have this. Okay, where we have this. I believe you can all see my screen. So let me just rename this to question. Let's rename this to solution. Capital budgeting. All right. Okay. So I believe this is good for us. This is the question, and this is the capital budgeting solution. Now, I'm getting started. Okay. So I am going to bring down, let's start to link this quickly. So we say we have our cost of capital as 5%. Okay, our cost of capital as 5%. So I'm going to link this immediately. I say this is our cost of capital. This is our cost of capital. So let me just copy that information, our cost of capital, our cash flow, and our year, including the initial investment. So let me just copy this down here. But I'm going to ignore this. Let me ignore this. Okay, so this is our cost of capital. Let me also bring that down. This is our cost of capital. This is our year. This is our cash flow. And okay, I'm going to remove this variable from here. I decide to delete this as well. Say delete. Okay. All right. For our cost of capital, we said it's 5%. So I'm just going to link that immediately. We say this is 5%. Then for our year, we have a lot of years, and I can also bring that down. Say our year, we have from 0 downward, which some persons might say they want to drag. Okay, they want to drag these years. Okay, so we have year 0 to 6. Then for our cash flow, you can see our cash flow here is given as this. Okay, and if we want to also follow that, it's important that you expand. Okay, you know, this is one of the errors. This is one of the errors in Excel. When you see this hash, 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 you should know that it means that the column is needs to be expanded. So we can also drag this to this number 6 here. So we can be able to see that. Now, this very column is too wide. So what I'm going to do is that I'm going to merge this. Okay, I'm going to merge it. And to merge, you highlight, you come to your home tab, you can see merge and center to centralize it as well. Same way we are going to do for solution, merge and center. So that is done. So I can now close and or reduce this column. So everything works perfectly. So I believe you're enjoying yourself. I believe you're enjoying yourself. So this is how we teach here in Miramar. We break down everything for you to understand it perfectly. And if you're interested in enrolling for our programs on Excel, data analysis, and other accounting software packages and accounting training, you can reach us. Okay, you can reach us by calling our number. Call our number 090. It's here 090 6840 8000, and we're going to respond immediately. Okay, now you can see the first 0 was not appearing. So what I'm going to do here is I'm going to put my apostrophe above and put the 0, and I will be expecting that it's going to appear. So these are just some short Excel tricks. Okay, we get a lot of them. Like when you're saying you want to put forms, which you come over here at the top and you click here so you can be able to come to more commands, and you proceed to your form, okay, to your forms, and then definitely you will get started with most of those things. If it's that of macros, you want to work on a lot of things, or forms, you can definitely say these are forms and we want to put all this into our forms. Okay, so that's just basically for that. All right, so let's proceed. So don't forget to call this number, and also don't forget, please subscribe to our channel and stay tuned for more of our value-added content. And I am confident that you're going to gain value from this very session. Okay, now we have here, okay, what we have brought down. So let's begin by calculating because we cannot proceed without calculating our pre-value interest factor, which is very important. So our pre-value interest factor is what we know. Those of us who did accounting or finance in school, or even economics, it's always given as 1 all over 1 plus raised to power n. So that also needs to be applied over here. So what I'm going to do at this point is that I'm going to come here and say we have, I'm going to come down here and say these are pre-value interest. Okay, these are pre-value interest factor. So I'll say P, you can just call it pre-value interest factor. Pre-value interest. And I said that our pre-value interest factor, I'm going to, let me reduce all this. Okay, our pre-value interest factor, like I said, it's important that we calculate that. So our pre-value interest factor for this, remember I said it's not going to be discounted because the cash flow for today is what? 0. So our pre-value interest factor is going to be our cash flow. So let's go about this quickly. So I'm going to use a short method here to do this. For those of you who have been asking me questions about referencing, automate, I'm going to use that right now. So what I'm going to do here is, for today, say is 1, all right? So we are going to calculate it from day 1 or period 1, if I want to call it. So I'm going to use my equal to sign and say 1 all over, okay? Bracket open 1 plus, bracket open 1 plus our cost of capital, and these are cost of capital. So I'm just going to click on it. Now, once I have done that, I will then I'll say bracket open, then I use my raised to power, okay? And remember, we'll say raised to power n as the formula for calculating the pre-value interest factor. Now, for that of the n is going to be the year. So that means the first year, which is year 1. So once I have been able to do this, I'm going to click my what? Enter. So if I click my enter, you can see it has given me that very interest, okay, for that. Now I'm not going to clear it, okay? I can decide to clear it, or I can decide to leave it, okay, to reduce the decimal. I'm going to leave it that way. Now, where the referencing comes in is this. Now, since we have been able to get our pre-value interest factor, I might decide, okay, remember we have been dragging all this, commanding the formula, okay, when we did the linking. So I can decide to also drag this, okay, to drag this down. But if I do this now, you notice that it's not going to give me the correct exact figure. It's giving me 1, 1, 1, 1. And why is it doing this? It's because I have not commanded. There's a way to command this kind of formula. Okay, when you do any calculation like this, you're going to use the referencing, automatic referencing, to be able to do that, which involves you putting a dollar sign, which is very important. So I'm going to undo this, then watch how I'm going to do that. Now I'm going to come here to the formula bar. I'll click in between that very C6, column C, row 6 of our cost of capital. Then I'm going to say F4. Okay, I'm going to use my F4 once. I'm going to click it once because F4 has different, you can see them changing. So I'm going to use the first F4, okay, to reference that. So once I do that and click enter, now it's going to command that formula. So if I drag it down, you're going to notice that that formula has been, and that figure have now been reflected. You can confirm it with your calculator, and that's just one of the tricks here working with advanced Excel. Okay, now it helps you to make your job faster instead of using your calculator or coming here to come and impute this same PVIF formula again. You can just proceed by doing this. Now, once you have been able to do this, the next thing you need to look into is the present value, because we need the present value for us to be able to calculate our NPV. And remember, our question says we should calculate our net present value, which means we are just getting started. So what's our present value? Okay, so our present value at this point, our present value needs to be calculated, and it's going to be our cash flow. Okay, we're going to multiply our cash flow with our pre-value. Okay, that's our PVIF. We're going to ensure that that is done immediately to give us the correct figure. So I'm going to come over here. Let me also try to color this. Okay, so this is our present value. Now, our present value, like I said, concerning our present value, we are going to multiply that of our cash flow, okay, with our PVIF. And the total is going to give us the present value. And, the total at this is going to tell us if this project is viable, first of all, even as we say we want to do what? Proceed. Okay. Now, what is our cash flow here? You can see our cash flow right here. You can see our cash flow right here. It's our cash flow right here is this. Okay. And okay, so to calculate the present value, like I said, we are going to um, multiply the cash flow. Okay, we're going to multiply the cash flow by that of our PVIF. So we're going to do that quickly so we can proceed immediately. So now what we're going to do, say equal to, where's our cash flow? This is our cash flow, okay, multiplied by our PVIF, our prevailing interest factor. So we're going to say enter, and you can see this is it. So at this point, we're not going to use the automate referencing anymore. We're just going to drag it because this is a simple calculation. So we're just going to drag it. So that's it's going to enter or command that formula for us to see so we can proceed immediately. So ladies and gentlemen, we have just arrived at a very good point, which is now going to lead us directly on how we can be able to proceed with the question we have here, which is our net present value, and that's of our internal rate of return and our profitability index. So first of all, let's look for the net present value. So we are required to look for the net present value. So what are we going to do? This is what we're going to do. Okay, we say net present value required net present value. So for our net present value, if you remember what I said before, I said that it is the amount by which the present value, which is all this, okay, the amount by which this present value of the cash inflow exceeds the present value of the cash outflows. And I said that if the present value of the cash outflow exceeds the present value of the cash inflow, that the net present value is what? Negative. So how do we calculate that now? Now Excel makes it easier. Excel has the formula for net present value, that's NPV. So what we are going to do here is that I'm going to select NPV and click on my tab key, and then it's going to bring down that for me. The first information we have here is the rate. Okay, the first information, like I said, that we have here is the rate. So what is our rate? Or what is that's the cost of capital. Now this is it. Okay, 5%. So we're going to say 5%, and we say comma. Okay, now when we have said comma, we are then going to copy all our what? All our cash flow. Okay, we're going to copy all our cash flow. Now, we are not going to copy your cash flow from this the year 0. That's the current one here. You're not going to copy this. Okay, you're going to begin from year 1. Okay, because we are looking at year 1 to year 6. So I'm going to come down to year 1 and drag downward to where we have year 6 or period 6. So once you have done that, you then add the what you call the initial outlay to it. And it's important that you get to do that. You have to copy it down and also brackets close. Okay, you say bracket close, then you say plus our initial outlay. Now, what is our initial outlay? What is that very initial outlay? If you remember, our initial outlay is basically this very figure which we have here, which has to do with our cash flow. So we have to put that into consideration whenever you're working here. You have to ensure that that of the initial outflow is what being captured, so as to ensure that all what you're working with is being done correctly. So we are going to proceed immediately by adding that very one. So we said it's here. Okay, so we're going to say, once we have done that, we'll say enter, so we can proceed immediately with that. Okay, so once we have done this, we say enter. So ladies and gentlemen, we have just entered this very one, and I thank God you can see it right here that we have just gotten that of our net present value. And I don't know if you have any question, you can comment down at the section below, or you drop your questions so we can be able to respond to your questions where necessary for us to be able to guide you on how you should go about this. So next we'll be looking at is calculating that of the internal rate of return. Okay, so you can see that we have just gotten the net present value. And if you remember what I said before, that the net present value is very important here, okay, for us. So we are going to, now we don't know if this particular investment is viable or not viable, because we must be able to say, yes, we've been able to determine if the investment should move forward, yes or not. That's based on if that's based on its viability. So how do we do that? First of all, we're going to compare our net present value with the total of our present value. So we're going to come here. Once we come down here at the end after the column I, column J, we can come to column J, okay, right here on column J, and we have to add up all the present value we have here. And you know, one good way to do that, we can just auto sum it this way, okay, so equal to this, then we say enter, or we use our normal sum, okay, we can say our sum here, say all this, okay, bracket close, we say enter, okay. So ladies and gentlemen, you can see when we enter this, you can bold it, it gave us the same as that of our net present value, which we have here. So what this means, if you look, it's positive. So it therefore means that this project is what? Is viable. So we're going to proceed. And remember, requirement 2 is that we should calculate our internal rate of return. And don't forget what I said before, that the internal rate of return is a good method, okay, which enables you to say, yes, this is the rate of return from the capital investment. And you know, like I said, that the internal rate of return here is that rate that makes the net present value to be equal to 0. If it doesn't make the net present value to be equal to 0, it therefore means that it's not correct. So we are going to do that and also do that checking too. So what do we do at this point? Excel also makes it easier. You say equal to, bring down IRR, and you can see the internal rate of return. Then you click on the tab key. So now we're going to use the internal rate of return when we are done to replace the cost of capital here to see if our net present value is going to give us 0. Okay, so now right here, you're going to add all the cash flow. Now, what are our cash flow? See them here. So I'm going to highlight from the first to the end of the cash flow. Okay, so once I have done this, I can bracket close and also do what? Say enter. So you can see that our internal rate of return is equal to what? 50%. Now remember, I said that the internal rate of return is that rate of return in which, or that makes the net present value to be equal towards 0. And this is a good analysis because we can compare this to determine if the investment should move forward. And so far, the investment is viable. So what do? We are going to replace this 50% of our IRR with our cost of capital. So let's assume, and we are expecting that the net present value should change towards 0. Okay, so what are we going to do at this point? At this point, ladies and gentlemen, I'm going to come to cost of capital, and I can say, let me say equal to, I link it up with the 50%, and I said enter. Now, if I say enter, you notice that the net present value is what? Equal to what? 0. And if you also check the present value total, it's also equal to what? 0. So at this point, it means that yes, we're on the right track. So lastly, our last, we can change this back by undo on the key, and we can proceed. So our last requirement is the profitability index. So I'm also going to copy our profitability index, or I can link it up from this very section here. I can say equal to, I go to question and link up this profitability index down here. Then I can also do what? Color this. Okay, can say, let me bold this for us to see. So ladies and gentlemen, for the profitability index, if you remember what I said that it is a variation of the net present value approach to comparing projects or comparing investment. And my lesson on Sage, where I taught on how to track cost by project on Sage, I looked into some of these areas which are very important as far as revenue and expense is concerned for each project. So the profitability index, what it does basically, like I said, it does not really stipulate the amount of cash return from a capital investment, but it provides the cash return per naira that was invested on this project or investment. So remember, we are working with our naira currency, and there are a lot of ways you can do that to check that. So moving forward on in that regards, so for the profitability index, Sage also Excel also makes it a kind of easier for us to do that. So what we are going to do here is that we are going to add our net present value, which we have gotten here. We're going to add it with the initial investment. So at this point, we're going to bring down our initial investment, and then you can see this our initial investment is what 100,000 was what was initially invested. So what do we do now? We say equal to, okay, so we say equal to, what is our initial investment? Our initial investment was given as 100,000, which we have here, but I will not advise you to do it this way. Instead, what you're going to do, come back to this very sheet, okay, come here, let's call this our initial investment. Before that, let's claim this equal to, so let's come here and link this up. So say equal to, this is our initial investment, we say enter, then equal to the amount itself, we said is 100,000, okay, and this is it, 100,000, which we can decide to increase this and also to grow this. So for the initial investment is also given as this, okay, and I will advise you color it separately. So then at this point we come back, and don't forget I said to calculate the profitability index, okay, is going to be our net present value plus our initial investment divided by our initial investment. Now most times a lot of persons makes mistake at this very point when calculating this, okay, but this is the best way you can do this. So what do? You say equal to, then you say open brackets, okay, you say open brackets, what's our net present value? This is our net present value, then say plus our initial investment, then you say bracket close, okay. Then once you have gotten this, you then say divided by our initial investment. So this is the formula you're going to use when you're trying to calculate the profitability index. Then you click on your what, enter. So ladies and gentlemen, you can see right here that our profitability index is 2.93. okay, this is our profitability index. And same way, if we are saying we want to replace the cost of capital, which is the rate, with our 50% from our internal rate of return, if we say it's equal to our 50%, okay, since you'll be expecting the net present value to be equal to 0, profitability index is also going to be equal to 1, so we can undo this. So at this point, this problem have been solved, and this is just the correct way can be able to solve and analyze this, most especially as far as capital budgeting is concerned. Okay, so you can keep in touch with us and calling our number right here on 0908408,000, and you can also visit our website here below by clicking on it, okay. It will take you there, so you can get in touch with us, okay, get in touch with our services, get in touch with our products, get in touch with our training programs, and we'll be expecting to see you. So please watch, practice, and don't forget to subscribe to our YouTube channel. Thank you very much. My name is Williams, and I will be hoping to see you during our next session. Thank you, and God bless you.